Welcome to Barchart's series of webinars designed to enlighten you on a variety of trading ideas and concepts, inform you of the features and tools Barchart provides related to these concepts, and offer you some traders' insight to help you make a more informed investment decision. Today's subject? Well, today is a bit of a departure from our regular weekly sessions. We have a special guest today, Mr. Chuck Hughes, who will be discussing his high accuracy options strategy. Now, in today's marketplace, when it comes to trading options, I think you'll find a lot of complex and difficult strategies. However, Mr. Hughes' system is simplistic and I think very effective. And even the most novice or beginner options trader, I think, can understand and execute his system. Plus, he's going to show us how he uses Barchart to find these high accuracy candidates. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist. And as I mentioned, I'm very excited about having Mr. Hughes as our guest. And I want him to explain, his journey, his methodology, and his 4 simple rules that have made him a successful trader for multiple decades. But before we get to that, let me bring on our moderator and Barchart's project director, Gene Baker. Hello, Gene.
Hello there, John. How are you?
I'm excited about today. I know we've been planning this one for a while, and I always love to hear other traders' ideas and philosophies and methodologies. So I'm really looking forward to today's session.
Same here, same here. And I just want to remind everybody, if you do have questions while the session is rolling, just go ahead and drop them into the chat window. John and his special guest are going to be taking questions a little bit later on in the session.
Okay, you ready to get into it, Gene?
That's your cue to get into it. Let's go.
All right, just a reminder that today that is for educational purposes, and that decisions to buy, sell, hold, or trade securities, commodities, or any other investment involves risk and best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any loss or damages for you or anyone else that occurs as a result of any trading or investment activity that you or anyone engages in based on any information or material you receive through barchart.com and or our services. Okay, my special guest is, let's do this first. There I am. My special guest is a former Air Force pilot. He's been trading for 4 decades. He's a 15-time published author, a family man of 6 children, who several of them will help him with his options service, and he currently resides in California. Are you there, Chuck?
Hey,
there
good
you
morning,
are.
John.
How's it going, my friend?
Good, good. It's a beautiful sunny day here in California. Everything's good. How about you?
Very well. 6 children. How many grandchildren do you have?
3 with number 4 coming here shortly.
Are you a papa or are you a grandpapa or pop-pop or something like that?
I am a papa.
Oh, I'm a papa too. I know I don't look like it, but I'm a papa too.
Oh, is that right? Okay.
So let's jump right into it. So you said, it says in your bio here that you were in the service. So how long were you in the service, and what aircrafts did you fly?
Well, I went right from college to Air Force pilot training. I was on active duty for 6 years, and then in the Air Force Reserves for another 8 years. And I flew the C-141 Starlifter. That's a 4-engine heavy transport jet, and we supported the U.S. military throughout the world and also U.S. embassies. So I've circled the globe many times in my career.
And what about as a commercial pilot? What did you fly?
Oh, yes, I was a commercial pilot for one of the major airlines. Started out flying the Boeing 727, which they no longer fly anymore, and
Right.
DC-10, and then
Oh,
went on to the Boeing 767, 757, the
so
Airbus.
DC-10, that was supposed to be a great aircraft to fly. Did you enjoy that?
It was. It was very comfortable for the passengers. They loved the DC-10, and that was a great aircraft. Hate to see that one retire.
So let me ask you this. What skill sets did you learn as, let's say, a pilot that um, maybe have helped you as a trader?
Well, pilots are very disciplined. They have to follow checklists. They have to follow procedures. They have to follow a flight plan. They have to have a backup plan if you have bad weather en route, or if you have bad weather at the destination. You've got to have an alternate airport and enough fuel to get to the alternate airport. So we're very disciplined in following procedures, and that carried over really well with system trading for me. In the 1980s, I went to a series of Larry Williams seminars, and he's a systems trader. He taught me to trade systems. I started developing my own trading systems, and I still use the basic indicators today. So being a pilot carries over really well into system trading for me.
So I'm sure in your journey, you didn't just like, boom, one day you just start trading and you were instantly as successful. I mean, I'm sure you made some mistakes along the way. What kind of mistakes did you make that you learned from in your developing your process?
Well, I, like most traders, when I first started out, I was just buying out of the money options, and I was swinging for the fences, looking for the big return, but along the way, I had way too many 100% losers. Of course, if you buy an at the money or out of the money call option, and the stock is flat or down at option expiration, you lose 100% on your trade. So it doesn't take many of those 100% losers to wipe out your trading account. So I made that mistake in the beginning, just had too many big losers. And that led me to look at techniques for selecting options that have a higher percentage of winning trades. And we'll be looking at that in detail here in the presentation.
Yeah, so what I've always believed in as a trader, and I made a lot of share of my mistakes as well, is I really believe in the KISS method, right? Keep it simple over the complex, because I just feel that you can be more successful. And when you get into this complexity, you start taking trades out or taking you kind of make errors on your entries and your exits and all this kind of nonsense. And why I've asked you on and why I like your system is it's very simple, right? It's just a 4-step process, right? So let's look at that. And I'm going to do this so we can have a good session. I'm just going to turn our cameras off for the time being, if that's okay with you, my friend.
Sure.
All right, so let's walk through your 4-step process, and let's look at the overview on this one first. So the first step is we're going to look for a power trend buy signal, right?
Right.
And then from there we're going to look for a low risk entry, and you have a very specific technical analysis point that you use, right?
Right.
You like to use Barchart for looking for an opinion or strong opinion, and we're going to look at that. But this is kind of what also I like about your system is you like Barchart. So as we look at the 4th rule, which is your 1% rule, and you're going to tell us what that is. Tell us some of the things why you like Barchart, or what attracts you to using Barchart.
Yeah, I love the Barchart website. It's very easy to navigate. Um, they have very useful indicators on there, the new high list, new low list, top 100 stocks. And I especially like that technical opinion. I mean, if you type in a stock symbol, you get an instant technical opinion, gives you a snapshot of, how that stock is trading, and it even tells you what business model the company is in. So that's a really, using bar charts is a great place to find trades. I start off looking at the new high list first. That usually has some good candidates to further screen. The top 100 stocks, that's a great list also. So I start my trade selection process at Barchart, very uh, easy to navigate, very useful for stock screening. And of course, you have the screener tool also for options. And I love the rating. It's, is it a strong buy, a weak sell? So very useful information on bar chart.
So you mentioned the new 52-week high. So let's go to bar chart, and we're going to look at that. So here we're under the stocks, and it says new highs here, and I'm going to click on that. And you can, folks, if you come to our webpage, you can sort by new highs by different time frames. But here we're looking at the 52-week highs. And so it looks like today before we came in, it was about over 100 so stocks today. Yeah, we got about 148 are making new 52-week highs. So this is kind of where you start collecting a field of candidates, not necessarily jumping right into them, but do you collect like a watch list to say, okay, here's a stock that has now made a new 52-week high. We're going to kind of watch this one over the next few days or next week?
Yes, yeah, we like to look at this list daily, and then when you do that, you'll start to see stocks that show up, several times. They've made a series of new highs. Like I'm looking right now on the list, BROS is one of those stocks. Accenture, ACN is one of those stocks. So they've made a series of new 52-week highs, and we have those on our buy list.
Yeah, so one of the things we can do with our, we do default some screener. So here it says 52-week number of highs, and if I click on that, right, so you can see like Boston's Scientific has made 74 52-week highs. So the question I have for you is it more about looking for those that are just starting to make 52-week highs, or do you really like to find the ones that are like made, let's say, 20 or 30, or in this case, 74 new 52-week highs?
Well, yeah, we actually have a position in Boston Scientific. So we found that obviously before it made 74 new highs, it probably had somewhere around 10 or 20 new highs when we started looking at it. We also have a position in Robinhood there, HOOD, that's made 56 new highs. So most of these, we looked at them earlier in the up phase of the bull move, and we currently have positions in them. So
awesome. So again, maybe not one new 52-week high, but a series of 52-week highs, but somewhere, let's say maybe in where do you really get kind of juiced up to 10, 15, 20 new 52-week highs?
yes, yep, 10, 15, 20. We'll have it on the list, and then of course we wait for it to pull back, which we'll talk about in a minute, but we'll put that on the list. And a lot of times when it's making a series of new 52-week highs, the stock gets overbought, and we don't want to take a position, obviously, when the stock is overbought. So we look at step 2 in our trade selection process to jump into a price uptrend. So
let's not get too far ahead of ourselves. Let's go to your step 1. So first you get this buy signal, and you generate this buy signal based on, you want to see the 1-month price above a simple 10-month moving average, right?
Correct. We want to make sure the price of the stock is in a price uptrend, and we want to avoid stocks that are in a price downtrend.
So let's say, so here I've gone to our flip charts here, and I made this template for you. So here's Boston Scientific, and the red line represents the 1 month closing price, and the black line represents that 10-month moving average. So what you really like to see is, as a stock is crossing this 10-month moving average, that kind of gets you into that, I'm getting juiced about this. And here what we can see is, and I think this is kind of your philosophy is, those stocks that are making 52-week highs and then are above their 10-month moving average have a higher probability of continuing into a trend.
Correct. Yes. We simply want to see the stock trading above that 10-month simple moving average. If the stock is trading above it, the most likely future price movement is up. So we want to avoid stocks that are in a price downtrend, because if you do that, then you have to correctly predict when that stock's going to bottom out, start its price uptrend again, and predicting that on a consistent basis can be hard to do. So we simply only focus on stocks that are in a price uptrend, and to us, those are the best candidates, especially if they're making new 52-week highs. That's a confirmation of the price uptrend, and that's how we build our buy list.
So let me ask you this: is this buy signal less of a signal and more of a qualifier for candidates? In other words, this gives you permission to start that next step process of saying, okay, here's a stock that is above its 10-day moving average, its 10-month moving average, and now I can put that, I'm kind of narrowing down the field and put that in a list of candidates that I'm going to eventually trade from?
Yes, it's a qualifier, and we'll put a stock on our list if it qualifies and start monitoring the stock. And then we like to see the confirmation of the new 52-week highs, and that allows us to narrow down a big list of stocks to the ones with the best profit potential.
Okay, so let's go to your step number 2, which is now you've got this buy signal qualifier. Now we need to look for a potential entry. And I think you kind of teased this a little bit, right? That you might get a buy signal, but especially those that are making 52-week highs, but they might have gotten a little bit over their skis. These stocks might have gotten a little bit ahead of themselves. And, we kind of typically call these overbought stocks, right?
Right. Yeah. And obviously you don't want to take a bullish position in an overbought stock.
So how do you kind of assess that? And I know there's a lot of technical tools, and I know there's one that you're kind of fond of, right?
Yes. Yeah. We use the Keltner channels. They're similar to the Bollinger Bands. Both are good overbought, oversold indicators. We just prefer the Keltner channels through many years of experience using them. And we want to wait until a stock is trading below the upper Keltner channel. If the stock's trading above that upper channel, it's overbought. You don't want to take a bullish position at that point. You just simply want to wait for a pullback on the stock while it's still in a price uptrend before you pull the trigger. So we'll wait for a retracement of the stock below the upper Keltner channel before we'll take a bullish position. And that's saved us from buying a stock that was overbought and primed for a price correction.
All right, so let's go back to our 52-week highs. And again, I have a template that I made for you. This is the Keltner channels. Now, I know you use a little bit of a different modified Keltner channel, but this one here, for folks who are watching at home, this is a 20-day moving average with a 2 ATR upper and lower band. So in this case here, we're looking at Boston specific. Again, a stock that you said that you currently have a position in. But let's just move, from, let's say, this point in time. Here is a stock is outside the band. So and it's been outside the band here for quite some time. So this is a great candidate, but you would not have pulled the trigger on this one because it's not inside of the channels, correct?
Correct. It's currently overbought and it's currently trading above that upper channel. So we would not take a bullish position at this point. We took a bullish position back in December when it was trading below that upper channel, and that's worked out pretty well. But this is just a simple indicator to tell you if the stock is overbought, and we don't want to jump into a stock that's overbought. So
let me just look at Walmart here, because this one has kind of been in and out of the bands, and I apologize. This is one of the stocks that I do trade on a regular basis. So there's some of my numbers here, but so this is kind of what you're saying is here you're outside the Keltner channel, and then you come back inside. Now the question I have for you is, you say this is what you call the buy zone. Is there a timing aspect of it? Is it just you just want to see it inside the channel, or do you say in this case, you have multiple down days? Do you wait for one green candle or a number of green candles before you go into the channel into that buy scenario?
John, we simply wait until the stock retraces below the upper channel. That's an indication it's no longer overbought. I mean, you could wait for further retracement, but our criteria is we simply want to see the stock trading below that upper channel. And we did a lot of testing, 10-year testing of all 500 stocks in the S&P 500 index. And we did testing on these Keltner channels to see if it's a better buy if it retraces to the middle channel, or is it a better buy if it retraces to the lower channel. And it didn't make much difference in the results and the testing, but what did make a difference is buying a stock above that upper channel. That definitely degrades your profits in our historical testing. So by waiting for the stock to retrace below that upper channel does increase the profitability of the trade. And whether you wait till it gets to the middle channel or the lower channel, that didn't really make much difference in our historical testing.
So are there other positive trend identifying tools that you can use that help you in your decision-making process?
Well, we like to look at the Barchart technical indicator. That's a great step in our process because you're monitoring 13 different time frames for the measurement, and we're looking at Boston Scientific there. It's a strong buy, and we look more towards the shorter and intermediate term trend indicators that comprise that strong buy signal. Of course, we've already confirmed the longer term, so we like to look at those shorter and intermediate term ratings for a stock. And Boston Scientific, you not only have a snapshot of the 13 indicators as a strong buy, but you also have information on the company itself, so you know what kind of company you're buying.
So this is, again, one of those nice features that you like about Barchart, because you can come right here, you found a candidate, and boom, you can see what the technical indicators are. So folks, if you're not familiar, what Chuck is telling you is what we do is we kind of grade all of these different technical indicators on their common interpretation. And if, for instance, if the price of the stock is above the 20-day moving average, that would indicate a buy signal. Not necessarily a trading signal, it just means that we're seeing positive price action. And I think what Chuck is kind of telling us here is that, we've already kind of qualified these stocks at the higher end of a time frame analysis, but here we really kind of want to see that short-term momentum So this could be a little bit more of a timing aspect, right?
Correct. And it's great to have those confirmations from Barchart, because that helps you further narrow down your list of stocks. And
Awesome.
again, even though Boston Scientific looks great, it's still overbought right now, so we would hold off on taking a position.
Yeah. So again, we might on this page here, we might tell you, say, hey, it might be approaching overbought territory, so you need to be careful. Not necessarily of a trend reversal, but that that impulse now a bit of a correction in our uptrend. So again, so looking for that Keltner channel as you had mentioned, right?
Yes, and that bar chart technical opinion, that's a great indicator, gives you a quick snapshot of the trend status of the stock. So love to look at that indicator, find out what the company does, and look at the various um, uh, time frames there for the uptrend.
All right, so step 3 was the bar chart technical indicator. We kind of talked about that, how it represents 13 popular indicators and the general interpretation. And as you said, this is a great way to narrow down your buy list candidates and higher probabilities. Again, trend's your friend, right, Chuck?
Right.
So let's get to step 4, because I really feel this is the meat and potatoes of your process. Not only the option selection, but really this idea of why you want to be using your 1% rule. So what is the importance? Okay, so we found this is your conditionals, right? Your buy power trend buy signal, that again above the 10-month moving average. You want to be inside of the Keltner channel. That's your buy zone. And you want to confirm with, let's say, an intermediate and a short-term momentum using the bar chart indicator. So now we can start that option selection. So you like to look at options in this lens, this time value or the cost of holding an option until expiration, and that intrinsic value. So I guess what I really want to ask you is, why is the importance, as you've told me, to focus on the time value?
Well, as I mentioned in the introduction, one of the mistakes I made, which is uh, swinging for the fences when I was trading options. I started buying call options, out of the money call options, and I had too many of those 100% losers. So I had to find a way to avoid those 100% losers and increase the accuracy of my trading. So I started studying option pricing. And of course, options consist of time value and intrinsic value. All time value is lost. Of course, it decays every day and then goes to zero at expiration. So that and it'll go to zero whether the stock goes up or down. So that time portion of the option is really the true cost that you're paying the options market maker to own that option. So I started studying time value versus intrinsic value, and I came up with a simple rule for the time value portion of the option. And if you limit the time value portion to 1% or less of the stock price, then the stock only needs to go up 1%, and that option is going to start profiting. So you have to remember, if you buy an at the money or out of the money strike and the stock is flat or down at option expiration, it's going to result in a 100% loss for your trade. So we want to avoid those 100% losers. We want to increase our percentage of winning trades. And the way we do that is to use the 1% rule and buy an in the money strike that has time value at 1% or less of the stock value. So you know, a 1% move for the option to start profiting can give you a higher percentage of winning trades compared to at the money or out of the money strikes that might require a 5 or 10% move in the underlying stock by option expiration just to break even. So the 1% rule can increase your percentage of winning trades. And if you can do that, that can give you that discipline that you need to be a successful trader.
So let me ask you this. Since pricing of options, time is money, and then the more time you purchase, the more probability of success, right? So is there a sweet spot, or how do you balance this 1% rule as it relates to time to expiration? And do you find that you're kind of in this sweet spot of how much, because if you're only buying 1%, you're really kind of limiting the amount of time that you can buy a stock, right? Or I mean, time in the trade, right?
No, we normally go out 4 to 6 weeks on until expiration. That gives the trade some time to work out, and you can purchase a strike price that that's less. The time value portion of that option is less than 1% of the stock price. So there's plenty of opportunities to comply with this 1% rule and go out a month or 6 weeks until expiration when you're selecting the strike price.
So there is kind of this sweet spot somewhere between 4 weeks and 6 weeks, or let's say 20 calendar days to maybe 45 calendar days is kind of where you find a lot of your trading opportunities.
Yes, yeah, that gives the trade enough time to work out, and whenever we take an option position, we have trade management rules that we use, and when you use this 1% rule, you can actually use a protective stop with options. And if we have a 30% loss in an option, we'll simply exit and move on to another opportunity. So that 1% rule allows us to use a protective stop. If you buy an at the money or out of the money call, you could get stopped out in 1 day. So that's another benefit to these in the money calls, is that you can use money management. So we'll simply exit the trade if we have a 30% loss.
So this is what I did was I took Chuck's process and I created a screener for him based on some of his criteria. So let's kind of walk through this, Chuck, here. So here we have the current price. Here's the strike price of the option that we're going to look at. And then something that we call is the percentage of the price of the strike that we're going to purchase. But here what we're doing is we're looking at the middle between the bid and the ask. Now, why the middle?
Well, as option traders, we like to enter limit orders to purchase or sell options. And we found on liquid stocks, we trade, generally we trade very liquid stocks. And when you trade liquid stocks, you can put a limit order in at the midpoint between the bid and ask. And a lot of times you can get filled right at that midpoint. You may have to raise the price a little bit to get filled, but we generally can get filled at that midpoint. So that's the price we're looking at to enter the trade. And in this example, it looks like the Abbott 120 strike call is less, it has a time value less than 1%. It looks like it's 0.81%. So that would qualify under the 1% rule because the time value portion of that option is less than 1%. of the Abbott stock price. So,
And then to your point here is you're only paying 1% for time for 44 days, right?
right, right. And again, that time value, that's the true cost of the option because that's going to decay to zero whether the stock goes up or down. So that is the true cost that you're paying the market maker to buy that option.
So here's kind of an interesting, this is kind of, we look, you and I mean, love your example here, but, if I go look at, let's say, some of the technical indicators here, here's the 20-day moving average true range. And it says that, on average, this stock moves about $2.4 dollars or $2.50 a day. And I think this is kind of what Chuck is pointing out is, you think about 1% on an Abbott stock. Well, that's, if I do my math right, that's about $1.20. But this stock moves about $2.50 on any given day. So literally in one day, you could see a profit on this potential option, right?
Yes, yeah, and then that gives you more choices. You can we'll take partial profits if we have multiple contracts. We'll take partial profits a day later, or 2 days later, 3 days later on a stock if it moves in our direction immediately. But again, this one this has 44 days to work out, so we have plenty of time for this trade to work out. And just to correct that, John, the 1% of the stock price would be about $1.31. So,
Oh, excuse me, you're right.
yeah,
$1.31. So
yes,
this stock moves about 2% of its stock price on any given day.
right, right. So you could easily hit your profit target, initial profit target, if you're trading multiple contracts, a day later, 2 days, 3 days later.
So how long do you normally hold onto a position, or do you, as long as it's going your way, do you hold on to them through expiration or to expiration?
If we're trading, let's say 2 contracts or 3 contracts, we'll exit some at profit targets, but then we'll hold the third one until expiration.
Sort of a little scale out, ring the register, put some money in your pocket, and let that trade run out as well.
Exactly. Yeah. If the initial profit target, if you do that at about 3% move in the stock, you can get a 30% return on the option, and then hold your other contracts until a higher profit target or until expiration. And then when we get to expiration, if the stock is still on a buy signal and meets all our criteria, then we'll roll over the profits on that trade into the new trade, and that reduces the cost and the risk of the new trade. And if you do a couple of those rollovers, you can get your costs to below zero and then have no risk on the trade. So that's one of our money management rules, and we employ that with our trading services. And we have quite a few options where we have no risk because we're rolling over the profits at expiration if it meets our buy criteria.
I
And
like that sound, right? No risk, right?
yes, yeah. So that allows you to compound your returns if the trade goes your way. And after several of those, you can have zero risk.
So this screener kind of it approximates your process, and I just wanted to show some folks so here's the in the money probability. Again, we're probably going to be picking some candidates that have very high in the money probability. There's our Barchart opinion signal, and then that percentage, and then volume and open interest. Again, you said you kind of want to trade those ones that have a little bit more volume and open interest, but not necessarily a deterrent for you as long as that option is active, right?
Well, the most important thing to look at when you're trading options is the bid-ask spread, and you want to see a narrow bid-ask spread. You could have a very liquid stock, and if you're buying an in-the-money strike, it may not have a lot of volume or open interest, but that doesn't really matter. The only thing that really matters when you're buying an option is the current bid-ask spread. You want to just see a tight bid-ask spread, and it could have no volume or very little volume or very low open interest. But again, the important thing is the current bid and ask spread, because that's updated regularly, and that's what you're actually going to use when you're trading. You're going to put a limit order in on the midpoint between that bid and ask spread. So you like to see a narrow bid ask spread.
Okay. So we're getting a lot of questions, Chuck, about the filter. I just want to show folks the filter here, and what we'll do is we'll make a copy of this available with our slides today as well. So just hang in there with us, folks. So I really keep Chuck going because I'm learning a lot here. So Chuck, again, I'm kind of approximating your system. So you offer a system that, in terms of your screeners, that are a little bit more precise, and it helps you to do this risk management aspect. Plus also your techniques, and I know you don't want to give away all the candy store right now, those techniques how to really maximize those profits, right? So tell us about this here.
Yes, in this report, I go into detail on the 4 steps that we just discussed, and it's a great guideline. If you get this report, you can always refer to it later when you have time and really dig into this 4-step trade selection process that I've been using for many years.
So this is in our slides, and then there's a hyperlink here, folks, that you can get Chuck's. And then some of the other things in this report also is about your track record and your performance, things that at this point I can't verify, but you have the documentation for that as well, right?
That's correct. I've had a trading service for, well, it's been 25 years now. So I started in 2000, and I have a record of every trade signal that I've given out to members since 2000. So I have a long record history on this trade selection process in my trading service record, which is 25 years now.
Wow. I thought I was old, Chuck. No offense. Do you want to take some questions?
Sure.
Okay, let's do this. Gene, I'm going to just give me a second here, Chuck. I'm going to read a couple of these questions. So I feel like we've answered a lot of these. So give me a second here, Gene.
Yeah, I'm just hoping everybody can hear me here. So I'm going to send out to the entire audience in the chat the link. You see this, click here for more information on your screen. Well, obviously you can't touch your screen to click that, so I've just sent that out via chat to the entire audience here. I also want to let everybody know that you will be getting an email a couple hours after we finish today's session. It's going to have all of the slides along with that link that we just talked about here. So watch for an email a couple hours from now after the session ends. One other thing I do want to mention is, John's been showing you Barchart option screeners. He was in the long call screener. That is part of a Barchart Premier membership. We have all sorts of different option screeners and options tools for our Premier members. If you're not a Premier member, we offer a free 30-day trial, so I really suggest you take us up on checking that out, and you'll be able to follow along with some of the things that were shown in today's session. Okay, back to you, John.
Thanks, Gene. I appreciate that. Okay, so Jared asked something, Chuck, and I think you kind of answered this. He says, I want to filter out stocks that have a lot of slippage or doing that manually between the bid and the ask. Again, I think, from my personal experience, and maybe Chuck, you can back me up on this, that's why we kind of want to look for volume and open interest as a way to help us find those that have a lot of screenage. And you said it's just the distance or the width of the bid ask. So you could use a rule to say, well, if my bid ask is 2% of my greater than 2% of the stock price, then that's probably not a liquid contract. But as long as there's active trading, so for instance, let's say here we're looking at the Google ones right here, and so this one that has the 150 strike has a lot more volume and open interest. So I don't need to go to that. I just know that it's going to have a narrower bid ask. And the other thing is that, I didn't really ask you about this between weekly and monthlies. Institutional traders tend to trade more monthly expiration strikes than they do weeklies, right, Chuck?
Yes, there's more overall volume in the monthly, which of course becomes a weekly. But yeah, we'll trade weeklies also if we're trying to zero in on that 4 to 6 week time period. We will use weekly sometimes if they fit in well with that time period.
So here's a great question. So you're talking about your Keltner channels, and you mentioned that you had a position in Boston Scientific, excuse me. When you go outside the channels, does this mean that you take profits or close out the position, or you just want to continue to ride it on a position that you're in? You wait for your risk management tools that tells you to exit. So let me just qualify this. So an initial trade, you say that if you lose 30% of the initial trade, then that would be an exit. So do you use that risk measurement? Let's say you're up X amount, 50%, 100%, or whatever, or you've rolled this stock. If that stock option gives back 30%, does that mean you exit the trade? So again, how do you exit a trade from profitability?
Yes. Well, to answer the first part of that, we only use the Keltner channels for the entry. We don't monitor the Keltner channels after the initial entry. We use that rule just to get us in when the stock is no longer overbought. And then as far as the trade management, I mentioned we use a simple protective stop of 30%, and we'll keep that in place during the trade. But we won't exit if we have a retracement of 30%. We simply use the 30% just as a protective stop to exit the trade.
All right, so we have a question here about the 10-month moving average, and so this is really for a bar chart question. So somebody might say, somebody's asking, for instance, if they go to our chart here, and I go under our indicators, right under overlay. So we're going to look at moving averages here. And there you can see moving averages. So I can set up a moving average based on different time periods. But here I'm in a daily chart. So if I set a moving average based on a daily chart, then I'm going to get a daily moving average. So if I want to do a monthly moving average, then I'm going to do it in a monthly chart. But a 10-month moving average, if you think about it, there's 20 trading days in a month about, so that was really closer to a 200-day moving average. And I just want to kind of show you something here. So let's go look back at Chuck's example. So here is the 10-month moving average for, it was this Abbott Labs. So it's around 114.43. And under bar chart here, under our bar chart templates, we do offer a 20, 50, 100, and 200-day moving average. So if I put that in, and let's just look at the 200, let me turn off the 50 and the 100 here. And that comes in about 111. So, I mean, it's off by about $3 here, but it really, in terms of what we're using this for, right, Chuck? It's just, we just want to see the stock price above that moving average, right?
Correct. Yeah, we're simply trying to make sure that the major trend is up for that stock.
Okay. So Julio asks, how far are the expiration date for options? Again, I think we kind of talked about that. Your sweet spot is you want to try to get as much time as you can for that trade to work out, but you find yourself in that, let's say, 1 month to 6 weeks time frame, right?
Correct. Yeah, that gives it time for the trade to work out.
All right, so
And
here's an
again,
interesting question, Chuck. I'm sorry, I didn't mean to interrupt you. Go ahead.
yeah, and again, you know, you can't really use money management rules effectively when you're trading options unless you buy an in the money option. And that's one of the advantages of that 1% rule is that you can hold on to that trade for a while, and you can also exit quickly if the stock moves in your direction. But you can use these money management rules if you're buying in the money options. If you buy at the money or out of the money options, you can't really use the money management rules effectively.
So James answers a really interesting question. I think I know the answer, so I want to hear what your answer is why don't you use this system to say to do a vertical put spread, a credit spread?
Yes, you could use this system for that, for the the trade selection process for this. Yeah, you could trade a debit or a credit spread. This is a trade selection process that gives you a higher probability that the trade's going to work out, and so you could take spread trades with this trade selection process, and we do take spread trades with this trade selection process.
My answer would be into to Chuck's system is that if you do a vertical put credit spread, it has a limited potential for profit, where in your system, you really have almost unlimited profit as long as that stock trends, right?
Yes, yep,
That's
yeah.
the
There's
big difference, right?
yeah. This what we're looking at today are directional trades, and we're just focusing on buying a call option, managing that call option while we hold it, and if you buy a call option, it has unlimited profit potential. The call is going to profit as the stock moves up in price. So it's a totally different strategy than a spread trade, and the spread trades have their advantages and disadvantages. One of the disadvantages is your profit potential is limited on a spread trade, whereas in a call purchase, it's unlimited. So, but we also trade spread trades, and we kind of diversify our trading strategies by trading spread trades as well as directional trades.
All right, Chuck, I got a really good one here, and I think this is going to relate to an example for today. How do you approach your system around earnings? This is from John.
Yeah, that's a great question, and we will not take a new position if a stock is coming up on earnings. If earnings are, I would say within a week to 10 days, we will not take a new position in that stock. It's just too hard to figure out how the market's going to react to the earnings. We haven't found a way yet to gauge earnings, so we simply will not take a trade if the stock is coming up on earnings.
So about 10 days out,
Yes,
two
yeah,
weeks out. Okay, so
yeah,
this is what I'm going to put you to the test here. Are you ready for this, brother?
yes,
So Google came out with its earnings today, right? and you said this is one of the ones that has been on your list, right? So first of all, I just want to show you that their earnings came out yesterday, and then the chart here. Let's go to your chart and use your template. So, right? I mean, it dropped like 8% today. How do you handle something like this? I mean, if you were in this trade already, you probably got stopped out. I would guess, right?
Yeah, we actually have a spread position in Google, and we did not get stopped out. We still have a profit on it, but we trade in the money spread. So we sold. I forget exactly which strike we sold, but we have a spread position on Google, and we're still ahead on that one.
So let me go with this. Let's take this one further. All right. So you have a position in this one. This one is working for you. All of a sudden, the market drops 8%. Right? It's post earnings now, right? And you're still technically in your Keltner channel buy zone. Would you add to your position here?
I would. If you look at this chart, Google had a similar sell-off back in November, and it had another one back in September. So, it bounced off pretty nicely from those two sell-offs. So I would look at this as a buying opportunity.
Awesome. All right. Boy, I can't keep up with all these questions, Chuck, here. Is there some way folks can reach you, or if they have a specific question they would like to ask about your system, what's the best way? Just to reach you through, find that link on the slide that we have, and then, or do you have let's say an email address or something?
They can reach me at support@chuckhughes.com.
Support@chuckhughes.com.
Right.
Okay, great. I appreciate your time, and folks, I'm sorry I didn't get to all of your questions. I see a ton of questions. If you have a question that's specific to Barchart or any of the tools or templates that I've used in this demonstration, send your questions to our support@barchart.com as well. Chuck, thanks so much. I hope you had a good time. Did you like
Yeah,
hanging out with me today?
it was great being here today, folks, and discussing the markets with you, John. I can tell you're very, very experienced, and I think this was a great presentation. And I learn things whenever I do these presentations. Like, I did not know about that feature that you showed us about the number of new highs the stock is making. I did not know about that. So I
There you
learned
go,
something
buddy.
today. Yes, I learned something today, and I love giving these presentations and hearing from folks. And thank you, John, for taking the time to put this together.
Well, I appreciate it, and I always love learning new techniques. And to be honest with you, I used your system today to take a trade on a stock where it was paying less than 1% on the 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 call price, and I kind of bought it on a dip inside of an intraday trade, and before we came on the air, the trade was already up about 30%. So I was like, "Oh wow, this is
Yeah,
pretty cool." So thank you very
there
much,
you
sir.
go. Yeah, there you go.
So
Congrats on that trade, John.
nice having you on. Hopefully, maybe we'll get you back sometime in the future. Again, folks, you can reach Chuck at support at. Give me that email address again, Chuck.
Yes, it's support@chuckhughes.com.
All right, my friend. Thank you so much. Uh, Hope to hear from you sometime in the near future.
That sounds good, John. Thank you. Have a great day, everybody.
All right, folks. So I hope you guys enjoyed that. I really did enjoy that session today. Just to remind you, for next week's, we're going to get back to our old ways here, and let's see, the, archive, but upcoming. What we're going to do is we're going to look at one of our trading systems that we have on our Barchart platform, which is the Futures Trading Guide. And it's a trend following system. It's hypothetical using moving average crossovers. And I'm going to show you how I kind of use it, but how I can optimize it, or I will either delay entries on a lot of these signals or wait for more favorable conditions or confirmations. So now again, if you're not a futures trader, I would encourage you still to come and check this out, because futures or commodity prices have a great impact on, first of all, there are ETFs that you can trade, for instance, the GLD for gold. But then you can also think about the price of a commodity as it relates to those companies that make those commodities or use those commodities in, the creating their products or their end use products. So come and check us out for that one next week. Gene, did I forget anything? You said we're going to put that on our slides that.
It's already out there, John. So if you want to show people how to go to it's out there already. If you go to the archived webinars and call up today's session, although the recording is not there, it's going to be there in a few hours. Go ahead and click on that first link, exclusive, right there. Download the slides, and not only does that have the link to get Chuck's free ebook, it also has the screener setup that John was showing you in today's presentation.
All right, Gene, thanks so much. I appreciate that the last minute work there. I know you were scrambling behind the scenes to get that done. So good job. I appreciate that a lot. All right, folks, until next time, the best of health, manage your risk, and the good of all trading.